Caitlin Morgan is an independent captive management and consulting firm with over 30 years experience. We put all type of captives together, from group captive programs to medical stop-loss captives. A captive is an insurance or reinsurance company primarily supplied by and controlled by its owners, which are also typically the principal insureds. Normally domiciled in one of 15 states in the United States that have a captive statute. They're really meant for smaller, it's a smaller insurance company meant for people that are looking to self-insure some of their own risks. Any industry can form a captive. It really comes down to the size of the entity, whether they're large enough to justify formation. Benefits of a captive, the main benefit I would say is control, to control the risks of insurance. They get a lot more input into the claims management. They have options to oversee the investments. They can pretty much control every piece of the equation, from risk management, claims, underwriting. It's just a way to formalize your insurance risk management structure. A single parent captive, or a pure captive, insures the risks of related companies and is owned and controlled by the related company or its affiliates. A single parent captive is a closely held insurance company whose insurance business is primarily supplied by and controlled by its owners, and in which the original insureds are the principal beneficiaries. This is the most common type of captive and typically used for larger entities. An association captive basically insures the risks of their members, so whether it's a nursing home association, trucking association, basically they form the captive to provide insurance for their members. An agency captive is normally where an agency might take a book of their business, a profitable book of their business, and choose to take risk on it for purposes of having a unique product that they can offer their clients. A protected cell captive is a single legal entity divided into cells. So you can have 10 cells in one captive, and each cell is kind of walled off from all the other cells. So all the assets and liabilities remain in that cell. Each cell issues its own separate cell shares, allowing shareholders to maintain sole ownership of an entire cell while owning a small partition of the protected cell captive as a whole. It's really a cheaper way, or less expensive way, to get into the captive industry, in that the annual operating costs are significantly lower compared to forming your own standalone captive.